Well, thanks for the wonderful talk, Laura. I found that fascinating. I wanted to, as a member of the committee, wanted to take a few minutes to share a few thoughts, and from the perspective of both an entrepreneur and an investor. I do advise and collaborate with several funds. And on the flip side, I've also seen the pandemic from day one through the eyes of an entrepreneur. A little bit about myself here. I sit on the organizing committee of Founder World with a focus on property tech and health tech. And I originally came to Silicon Valley in journalism with the Wall Street Journal. I moved to Google and kind of fell into the startup world, and really particularly the health technology and fintech space. I've founded two companies and also an investment fund. Currently the founder of Uvise, which is a platform and a marketplace for on-demand virtual services. But moreover, I'm an economist and a technologist by education and training. And I started my academic career in astrophysics, actually. Kind of was fascinated with the modeling of systems. And that said, quickly realized what the life of a research astronomer looks like, and it's not so glamorous. So transitioned from sort of the highest levels of the hard sciences to economics, sort of the highest levels of the soft sciences, and transitioned a lot of my interests in modeling of physical systems to economic systems. And I'd like to just reiterate, we are obviously in a system of systems of systems, and we are seeing firsthand how disruptions in the smallest underlying systems can disrupt global economies. And so, everything is interconnected now more than ever. We are essentially in an unprecedented time in many, many ways. And so we, for years, have been burdened. I mean, everything from debt to various geopolitical complications. We, as a sort of metaphor, are a camel, and frankly, we've been stressed in more ways than one. COVID has illustrated quite clearly that when one system breaks, many come down with it. That said, the disruptions and the volatility that COVID has created also represent opportunities. And seen through the right lens, we can find a number of early stage entrepreneurial opportunities where enterprise is failing. And so in a way, we can find better ways to do things, and we're going to have to. We are seeing, again, unprecedented impacts on particular sectors, on food services, on travel, on obviously healthcare. Many of these industries and sectors have not come close to adding back the job loss that they've suffered. But within every one of these sectors are opportunities. And we are very clearly seeing this because honestly, COVID is a catalyst of sorts that's kicking us off a cliff and forcing us to truly rethink many of the technological approaches that we've developed. And a lot of these technologies that we've been discussing for a decade or more, everything from automation to artificial intelligence, we are seeing firsthand how they can be used for both good and bad. McKinsey has published a number of studies. They've questioned hundreds, if not thousands, of business and thought leaders, and just to give you an idea of how unpredictable things are in the world. I mean, this was the survey conducted in September of this year and last month, October of this year. The concerns differ widely, and this is within 1 month. And so nobody really knows how many of the economic dynamics are going to pan out. Even the thought leaders of our largest companies are clearly wavering month to month. But this is a direct example. This is a White Castle burger joint who has in a large portion of their retail and locations completely automated huge portions of their food processing. This is a robotic system called Skippy, I believe. They've implemented this in over 50 locations so far, reduced headcount, and frankly, a system like this costs about $2,000 a month versus 4 to 6 for the equivalent full-time employees. This is Tesla's Gigafactory here in Austin. We know quite well they're developing rapidly a variety of automation technologies and have just recently made clear that they're dedicating a non-trivial portion of this plant and other locations to actually developing robotics, novel robotics and humanoid robotics. And clearly they see a future for it. We're seeing disruption clearly in finance, and not just domestically, but especially internationally in terms of decentralized approaches. We're seeing disruptions at levels we've really kind of never imagined before. And that all said, I'd like to remind people, if you were to ask almost anybody, 20 years ago, what the future of mobile technologies would look like, this was likely their answer. And this is actually real. This is a product on Amazon that is indeed this size, and it works. But if you were to look at the progression of mobile technologies throughout the 90s, phones were becoming smaller and smaller. And this is where we thought things would go, a wristwatch-sized device. And quite honestly, it has turned out to be exactly the opposite. Our phones are larger than ever. And I bring this up for a couple of reasons. One is it's a very dangerous game projecting linearly and extrapolating past trends without understanding the underlying factors and technologies and causes. Likewise, 10 years ago, we were talking about disruption, and this was at the tip of everybody's tongue. Everybody's talking about 3D printing and rapid prototyping, and indeed it is an amazing technology, and it's a multi-billion-dollar market. But frankly, we're now seeing the disruption of multi-trillion-dollar markets. The disruptive power of technology that we're observing is accelerating, and it's not really showing any signs of slowing down. So 10, 20 years from now, I suspect the most disruptive technologies are things that most people are not talking about right now. And I imagine it's everything from artificial intelligence to novel energy technologies. So, what does this mean for startups? Unfortunately, early stage seed and angel deals since the beginning of COVID are down considerably, about 37%. We hear a lot about venture capital accelerating, and it's true. Late stage VC deals are. They've actually picked up about 90% since the beginning of COVID. But all is not bleak for early stage companies. There are a number of indicators. This is the number of applications to obtain an employer identification number for tax purposes. And this is a fairly accurate and reliable metric of new startups, new business. And we've seen a dramatic growth. And so when you reconcile those two facts, that there are a lot of early stage with significantly fewer early stage financing deals, you have to realize, that most people are doing this without funding. And I think this is something that more entrepreneurs should consider, really putting their revenue model first and venture capital and fundraising second. So, going forward, there are a lot of unknowns. There are obviously huge supply chain disruptions. A lot of countries are dealing with legal and regulatory uncertainties, especially within the private sector. We don't know how a lot of governments are going to react from a regulatory perspective, especially when those technologies threaten their key sources of revenue. Case in point, as our previous speaker showed, the major oil producing countries, especially those like Russia and the Middle East, are going to do what they can to protect their revenue sources. And so, in the U.S., we're seeing labor and talent shortages we've never seen before. We have no idea where the future of white collar work, particularly, is going to go. How working from home is going to persist over the long term. We have a variety of cultural dynamics and trends accelerating, and that the pace of change is accelerating. And so, we're going to become much more reliant on I think, organic and viral marketing. A lot of our traditional modes of marketing no longer are functioning as they used to. And again, I'd like to remember and remind folks that our media has in large part turned into clickbait and fear sells. And I'd encourage people to read between the lines. There's a lot of reasons to think that early stage investment will pick up. These trends do tend to trickle down. We are absolutely seeing consumer demands shifting. We're seeing, in my opinion, enormously overvalued public equities markets. People are getting nervous, and private equity and VC and other early stage investors are going to be pressured to seek earlier stage deals. Moreover, enterprise is showing that it's really not as agile as it would like to be, and this presents a huge number of opportunities for early stage innovators. Again, I won't get in too deep on the marketing side of things, but everybody in every industry is spending less and much differently on their PR, their marketing, their digital, their outbound, and this all represents opportunities for startups. Volatility and disruption has always created opportunities, and startups have a number of advantages, not just their structural cost advantages, but their ability to adapt and rapidly roll out new products and meet customer demands that enterprise will take much, much longer to produce. So I'll leave it there. I'm happy to answer any questions if anybody has any, but I'll gladly turn it over to Sylvia and our speakers for the day.
Hey, thank you. Thank you, Alex. Let me turn on my video. A quick question for you. Can you elaborate a little bit on this lack of investment on seed and pre-seed founders versus venture capital? Is it, in your opinion, driven just by psychological reasons, uncertainty, or is there something that is more factual behind that?
I do believe it's all of the above. What we are seeing is fewer deals that represent larger sums of money, and I think that it's just the nature of the industry. I think that a lot of investors, as they transition away from public equities markets, are looking for the lowest risk opportunities, and we all know that later stage venture is lower risk than early stage venture, but obviously risk is always commensurate with returns and opportunity. So I do think that it's simply natural risk aversion. I do also think that there's simply more uncertainty, and the overall industry of the overall early stage startup space is simply more risky when it comes to especially incorporating the dynamics that COVID has created. But again, I do think that it's clear many are thriving and succeeding, but it's typically those that are scrappy, lean, and revenue first, not those relying on huge user adoption numbers, and rather than revenue and net profit numbers.
Okay, thank you, Alex. Any other questions?